All right. Today is Wednesday, September 21st. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, although it's going to be shorter and sweeter because I want to get this to you before midnight Pacific time. So we're not going to do the In Focus segment, which was supposed to be my review of the FOMC minutes and the conference by Jerome Powell. But rest assured, my review of the FOMC will be out in a separate video. So I'm going to get this to you right now, and then I'm going to go back and record my FOMC review. And you don't want to miss it because Powell said a lot of things today, a lot of important things, such as the 3 conditions he's looking for to pause increasing interest rates. He also slipped and told us when the pivot is going to happen, so you don't want to miss that video. But for now, let's just do some commentary here about what happened and proceed with the market information. You see, ahead of this FOMC meeting and the conference by Powell, we talked over the weekend how the market maker is better positioned this time around because there are no surprises, at least to them. Last week, they made the mistake of being over-positioned and over-hedged to the upside because the assumption was the CPI will come out cool, confirming peak inflation and equities will rally higher. But once the CPI came out hotter than expectations, the market maker got caught with their pants down. They had to scramble and hedge to the downside, and hence the oversized market reaction. This time around, there are no surprises. The market maker knew ahead of time, along with all of us, that the Fed will indeed increase interest rates by 75 basis points. The problem is, are there any surprises or any additional color from Powell during the conference? Because that would move the market one way or the other in an excessive way. And perhaps we got some of that. You see, the market maker might have been better positioned than last week. Yet a lot of traders, a lot of market participants remain stuck in this theory that the Fed is not serious about tackling inflation. And the point here is, it's not whether the Fed is serious about tackling inflation or not. The question is, do they have any other choice? And the answer is no. They are forced to battle inflation, even if that means crushing the stock market, whether they like it or not. It's not a matter of choice anymore. But a lot of market traders and investors remain stuck in that mode, that the Fed somehow, somewhere, is going to pivot. And therefore, ahead of the FOMC meeting and the conference, a lot of folks closed a lot of trades and exposure. The majority of these trades and exposure happen to be on the bearish side. Be it shorting equities or long the dollar, shorting bonds, it doesn't matter. A lot of traders were closing these trades ahead of the Fed's decision. Most importantly, a lot of folks closed their bullish bets on the dollar. And the market maker looks at this action and says, okay, I am hedged either way, but why are these people closing their bets ahead of time? Specifically, their bets for the US dollar to go higher. Maybe they know something, or maybe the expectations are the dollar goes down after the meeting, and the market maker starts to hedge less to the outcome of the dollar moving higher based on that alone. So when the FOMC comes out with the 75 basis points and then Jerome Powell comes out hawkish with the commentary, all of a sudden these market participants and the market maker who closed their bets and their hedges for the scenario of the US dollar moving higher after the FOMC, well, they start to scramble to get back into these positions again, and hence the oversized reaction in the US dollar. It could have been a lot worse, folks, if the market maker was not hedged ahead of time, if they did the same mistake of last week, but they were better hedged this time around. Regardless, this phenomenon of traders closing their long dollar bets ahead of the FOMC is telling, not just of the market skepticism of Jerome Powell tackling inflation properly, but it is also telling of the psychology of bears, that they remain confident, but they're still traumatized with these sharp market rallies. And not only that, they're still stuck on the sentiment indicators. They see the sentiment indicators really bearish. They put 2 and 2 together and say, well, maybe if we have a surprise from the FOMC, we could see massive short covering. Maybe the extra bearishness is a contrarian indicator. We talked about that in details. The tweet from Jim Bianco, that the extra bearish sentiment in all of these indicators, that works in bull markets as a contrarian indicator, that you should buy the dip. But in a bear market, of course the sentiment has to be bearish, and it continues to get extra bearish by the day. For example, ahead of the FOMC, here's the headline from Bloomberg, I believe. It says the S&P 500 history points to a sharp bounce after the Fed meeting. And they're using this positioning indicator that is extremely bearish right now to say, hey, after the FOMC, the likelihood is the stock market goes higher because the sentiment is too bearish. The positioning is too bearish. Short covering is coming. Yada, yada, yada. And also another thing shaking the confidence among bears is all of these analysts and pumpers all over the place coming out and saying, oh, this is the bottom, this is where the market is going to rebound, etc., etc. The top market pumper right now happens to be JP Morgan. And before the FOMC, they came out and said the stock market sell-off is almost over, and resilient earnings and slowing inflation means a rally is on the way. Now, you don't have to guess to know which analysts is saying this, but here it is. The current sell-off in stocks is likely nearing its end, and a rally could be imminent as corporate earnings remain resilient and inflation expectations moderate, according to JP Morgan's Marko Kukuranovic, who wrote in a note to clients on Monday. And Kukuranovic expects the same, telling clients that after the Fed's expected 75 basis points rate hike tomorrow, another 100 basis points in rate hikes could be on the table by year end. However, Mr. Kukuranovic says, but that doesn't mean stock prices cannot buck their current downtrend and rally from here, according to the note. Why is he saying this? Here it is. We believe credit risk will remain contained in the U.S., even if growth slows further, and see potential for a strong rally whenever macro picture turns less negative, Kukuranovic said. Okay, so when is that going to happen, Mr. Kalanovic? Just buy the dip and assume it's going to happen someday? In the meantime, think about it. What we talked about yesterday. Did Jerome Powell come out with any surprise such as chocolate or strawberry? Of course not. He came out plain vanilla with the 75 basis points. But then, during the conference, he revealed that he actually came out French vanilla, a little bit of flavor. He also added a bunch of M&Ms on top, a bunch of sprinkles, maybe a little hot fudge too. We're going to talk about that in details in the upcoming FOMC review video. But for now, we got the CPI out of the way. We got the FOMC out of the way. So what comes next? What comes next is the technicals and the psychology, because we're done with the fundamentals, at least for now. We're going to talk technicals and the charts analysis per usual, but what about the psychology here? I know a lot of you like the think about what you think about game, so let's play it again.
Think about what you'd think about. Think about what you'd think about.
I want you to put yourself in the shoes of the bulls right now and think about what you think about after today's action. Would you buy the dip when the chairman of the Fed says, I want to see more pain in the economy, which means less corporate earnings? Can you buy the dip right now when the chairman of the Fed says that we're getting closer to the lower range of what we consider to be restrictive when it comes to interest rates? Of course not. You'd be delusional. So what is the psychology among the bulls right now? Think about what you think about if you're a bull. You're going to wait till the June bottom. You're going to wait till the retest of the June bottom and then reassess. And if there are changes, if there is a pivot at that time, then you buy the dip. But for now, the psychology says the bears are in charge. They're going to be emboldened now. And the bulls are going to step out of the way, which means the charts will go down to the June bottom, unless something changes tomorrow. Some piece of news comes out. But absent of that, the consensus is we're going down to retest the June bottom. And when we talk about think about what you think about, look at this market psychology chart. Where do you think we are right now? The answer is, in my opinion, we're moving from the denial stage all the way to the panic stage. So we're about to see the panic stage once the June bottom is taken out. And do you really want to stand on the wave of this upcoming tsunami of selling? Not really, not me. And this is the psychology that is dominating the stock market right now. So for now, the assumption is we're going down to the June bottom, absent of any surprise coming out soon. By soon, I mean as soon as possible, by the end of this month. Otherwise, we're going down to the June bottom, and in all likelihood, the June bottom is not going to hold. And with that lovely outlook that I just gave you, let's move on and cover the stock market information for you. And we start with the closing of the indices today, and here we go. The Dow Industrial Average down by 522.45 points, or a decline of 1.70%. The Nasdaq down by 204.86 points, or a decline of 1.79%. The S&P 500 also down by 66 points, or a decline of 1.71%. The action was jerky right after the FOMC came out. Initially, the market went down, then it went higher again after Powell started speaking, and by the time he was done, the stock market decided to flush down. Knee-jerk reaction, sure, but why didn't the market hold on to the gains that came out initially as the conference started? We'll build on that conversation in the charts analysis, but for now, let's look at the performance of the sectors of the market. All down, all in the red, shame on all of them. We're not going to give out any medals today, but the laggards were led by cyclicals, big time, followed by services, communication services, and then financials. What about the advance to decline ratios? NYSE 16% advancing versus 82% declining. The Nasdaq 23% advancing versus 74% declining. I say usually, but not always, when we have such suppressed ratios, we get a bounce. This bounce could happen overnight, it could happen right off the gate in the morning, but it's not guaranteed. It is what usually happens. Keyword usually. Moving on to futures, commodities, what's going on here? I would actually argue that commodities held on a lot better than stocks. Yes, we have some downside here and there for lumber, for coffee. Lumber was down big, over 4%. We saw some downside in grains. Soybean oil was down over 5%, for example. But the damage was not as severe as we've seen in equities. Perhaps initially, when we got bad news re Russia-Ukraine, and the news is Russia's mobilizing to escalate the invasion, the reaction right away was energy commodities shot up higher. At one point, crude oil was up by 3%, and then it went down again to negative. So we have this tit for tat, this back and forth between the tailwinds and the headwinds for crude. The tailwind being what's going on in Russia-Ukraine. More escalation means tighter supplies and higher inflation, specifically for energy. But we have a massive headwind here, which is the hawkish rhetoric by the Fed, and increasing interest rates higher. What does that mean? It means that for crude to move higher, the supply shock has to be even more intense than before. What used to move crude oil higher in the past, when the Fed was not tightening, or was tightening, but not as aggressively as they're doing right now, that doesn't work anymore. The supply shock has to be even bigger, more disruptive for crude oil to move higher. In these conditions with such massive headwind, that is the Fed. Moving on to the big casino, the options market, what's going on here? The volume pretty much the same as yesterday, but we're seeing more buying of puts. The traders are becoming more hesitant in buying calls. They're not as emboldened as they used to be, at least before the latest CPI. And this is a bad sign for the bulls. The market moves based on three things. Number one, the fundamentals. Number two, the technicals. Number three, the mechanics. By mechanics, we mean the options market. Well, the fundamentals right now, not in favor of bulls. The technicals, as you will see in a minute, not favorable to the bulls. The mechanics, not favorable to the bulls. We need to see more participation and more buying of call options. And this is not happening, at least not right now. Regardless, Tesla, the souffle, came up number one with around 1.7 million contracts traded today. About 52% of those were calls. The number two, Apple, at around 1.6 million contracts traded for the name today. About 52.5% of those were puts, not calls. A lot of bearishness here against Apple, and it is telling. And then we have at number three, NVIDIA, at around 725,000 contracts traded today. About 50.5% of those were calls. Moving on to the unusual activities that took place in the options market today. We start with the ticker ATUS. This is a broadband company, and it has been crashing all year long, but somebody's betting for a bottom here and a rebound. They bought the $8 calls for the expiration date, October 21st, with expectations that the name could rebound and move higher, scoring gains of over 7% by then. They paid around $0.50 a piece to enter this trade, all in all spending around $1 million. At the bottom of the table, what about the ticker SE for C Limited? Well, somebody sees more downside for the name. They bought the 45 puts for the expiration date, December 16th, with expectations that the name will crash and lose more than 21% of its value by then. They paid around $2.90 a piece to enter this trade, all in all spending around $1.8 million. Continuing with interesting trades, what about the ticker SPY for the S&P 500. We still have some bulls alive because somebody bought the 400 calls with the expiration date October 19th with expectations that the SPY could rebound and gain more than 6% by then. They paid around $2.60 a piece to enter this trade, all in all spending around $1.5 million. And then we have the ticker SG portfolio, but I had to dump it at some point. Yet somebody sees a rebound coming for the name, perhaps more upside. Big time. They bought the 170 calls for the expiration date November 18th, with expectations that the name could move higher and score gains of more than 20% by then. They paid around $3.75 a piece to enter this trade, all in all spending around $2 million. And then what about the ticker BTU? For coal. The name has been on fire this year as coal prices continue to move higher, but recently the name went down by a lot and somebody sees a bottom here, a rebound coming, and they bought the $25 calls for the expiration date November 18th with expectations that the name could move higher and gain more than 17% by then. They paid around $1.70 a piece to enter this trade, all in all spending around $850,000. And lastly, what about the ticker DY or DICE, DICE? A biotech company that specializes in oral therapeutics. Now, when we see these bets on biotech companies, all of a sudden, somebody knows something. Usually it is an insider trade, but to each his own, I guess, specifically when the SEC remains in a coma. In this case, somebody sees more upside for DICE, and they bought the $22.50 calls for the expiration date, October 21st, with expectations that the name could pop higher and gain more than 20% by then. They paid around $3.85 a piece to enter this trade, all in all spending around $1.7 million. Moving on to the heat map, what do we see here? A sea of red, bloodbath across the board with very few exceptions. Nvidia is one, perhaps the Jim Cramer inverse ETF is in play. And then we have in consumer defensives, we have the ticker GIS for General Mills. And this channel has been bullish on this name. When we look at the chart, look at this. It is blasting higher. This is a monthly chart. The name just made all-time highs. This year so far, we don't have a lot of names that made all-time highs. This is one of the few exceptions. Now, the name is getting a little overbought, a little overextended, meaning it's going to come down at some point. I wish I've gotten into it earlier, though, because it held on pretty good throughout all of this route. The problem is, the name pays about 3% worth of dividend right now. On the other hand, you have the 3 months bill, for example, also paying 3%. The difference is, one is risk-free, the 3 months bill, one is not. GIS. One pays an annual dividend, and one pays at maturity. You put two and two together, even a name like GIS, which held on pretty good, and it remains an inflation-proof kind of company, kind of stock, even a name like GIS becomes unattractive in this environment because we have risk-free that pays more. So why would I assume the risk of holding an equity in this environment? And hence, TINA is dead. Let's talk some corporate news here, and we start with the ticker BYND, Beyond Meat. You might have heard the news already, that the COO, I don't know what happened to him, all of that fake meat got to him and he started eating somebody's nose over the weekend. Now he's going to jail and he lost his job. Now there is a joke here. All the ingredients are available, but my head is a little too clogged right now. But you got all the ingredients, so make up your own joke. You got the CEO of a fake meat company biting somebody's nose. Then you got Mike Tyson. Then you got the company Tyson, which produces meat and happens to be a competitor of Beyond Meat. Put these ingredients together and come up with a joke and write it in the comments, and the best one gets a cookie. Anyways, we have the souffle. Tesla owner says he's locked out after battery died and the replacement costs $26,000. Congratulations. If I ever get locked out of my car, I just use a hanger. Boom, problem solved. And then we have Meta and Google, all of these big tech companies. They're also getting rid of employees. Both companies are getting rid of staff. Facebook parent is looking to reduce costs by at least 10%. So a lot of people working for Meta under the tyranny of Zuckerberg will lose their jobs. We have more bad news when it comes to layoffs. In the aftermath of the fallout between Gap and Kanye, here comes Gap laying off 500 employees. The next step is bankruptcy. On top of that, Nordstrom is also laying off over 200 people in one of their distribution centers. And on top of that, we have Boeing now outsourcing more jobs to India. After all the tax cuts that we gave them, all the handouts that we give them, billions and billions of dollars, they're still outsourcing jobs to India. rather than creating jobs here in this country. So why not just tax the living hell out of them and build some roads and bridges and perhaps give the American people access to affordable health care? That would be better use of the money than giving these bastards another tax cut. Anyways, moving on to the heat map for the ETFs, what do we see here? A bloodbath across the board, no exceptions here. The inverse indices are the only one along with the VIX proxies, but we do have natural gas in commodities, UNG moving higher, along with the leverage ETF, BOIL. We have silver, SLV moving higher. We have gold ETFs moving higher, be it the GDX or the GLD. And we also have the TLT moving higher. So if we have any hope right now for the bulls in this program, any glimpse of the light at the end of the tunnel that perhaps we can have a relief rally coming, these are your leading indicators. The GDX, gold moving higher, along with silver, and you also got the TLT moving higher. That's about it. We have to see more to say, okay, we have a relief rally, the dollar goes down, yields go down. You know the story. And for that, let's move on to the charts analysis, and we start with the SPY 30 minutes chart. What do we see here? The obvious is there was an attempt to move higher, and it stopped right at the gap at around 389. The stock market changed its mind, and it moved to the downside. And it lost 385 as support, and now it is eyeing 373.5 as support. Now think about what you think about. Is this bullish action or is this bearish action? The answer is, technically speaking, it is bearish action. And the reason is the chart went higher and it failed. It got rejected big time. Now, the bulls will counter and say, but this is a knee-jerk reaction. Wait till we digest and absorb what Jerome Powell said. And when we do that, we're going to realize that the tightening cycle is coming to an end, yada, yada, yada. And the dollar goes down, yields go down. The stock market catches a rebound. But right now, looking at what we have, the information that we got right now, the bears are in charge. And here is the daily chart for the continuous contract for the SPY, the S&P 500. The bulls lost an important support, 3,855. We're now eyeing 3,720.5. We'll see if that's going to hold or not. The volume is not good for the bulls. It is above average on a down day. The momentum indicators are curling their way down. We're seeing these negative impressions in the histogram of the MACD getting larger, indicating that we're not through yet. The market is seeking support downstairs. So downstairs we have 3,720.5. The next one we have is the June bottom. And therefore I continue to say, let's just get it out of the way. Get us down to the June bottom and let's see what happens from that point on. But here's the problem for the bulls. This is the weekly chart for the SPX, the cash index. We have yet to close for the week. We have 2 days available for any repair job, but they lost their last hope, which is 3,800. If the chart closes below 3,800, then any potential for the reverse head and shoulder formation is gone now, for good, which means down we go. And here's the Q's 30 minutes chart for the NASDAQ. What's going on here? Similar story. We got an initial pop right after the FOMC, but then we got a hard rejection at around 294. And the chart closed at the lows of the day with high volume. We're now eyeing 280 as support. Is this action bearish or bullish? The answer is easy. It is bearish. The technicals say bearish. The bulls will counter with, hey, this is a knee-jerk reaction. We'll see. And here's the daily chart for the continuous contract for the NASDAQ. A bearish development here. Number one, the bulls lost 11,689 as support. Number two, they lost any formation of higher lows. And that happened the moment the curve, the saucer bottoming formation, was out of the window. And the chart made a lower low formation. The volume moved higher on a down day. The momentum indicators are negative, and they are accelerating their way to the downside. This is not a good sign for the bulls. Good sign for the bears, indicating that where is the next support here? The next support is the June bottom. The IWM, what's going on here? 30 minutes chart. Similar story. We got the pop, and then we got a hard rejection from where? The resistance at around 181, and then the chart closed at the lows of the day. Bearish action, and the next stop is 174.22. And here's the most important chart, the Dixie. The bull flag played out. The chart is getting severely overextended here, but that doesn't mean it should go down right away. It could actually produce massive pops before it pauses, or it consolidates, or it moves down slightly. So for now, this is a train going one way, and that is the northern destination. You don't want to fight it. You want want to see solid signs that the dollar is indeed topping and reversing before we say, okay, at least we can get some breathing room here and have equities move higher by a little bit. For now, we don't have any of these signs. So the expectations right now for, let's say, metals, specifically gold, are negative. Here's the chart of gold. It is forming a bear flag formation. On top of that, today gold gave it a shot at 1685. Didn't happen. And now it's moving its way down. This is a negative development, technically speaking. And if we go down, how far can we go? We have to zoom out to the weekly chart of gold. We have support at around 1,611.34. That would be another 3% or so to the downside. Then we'll see what happens. And here's crude, a daily chart. For Brent, the bulls still have some hope here. The chart did not make a lower low. It did not break below 85, but they're running out of time. If they cannot do it by the end of the week, well, guess what happens? The sellers will show up and they will get the chart below 85. Another important chart is the daily 10-year yield. What's going on here? Yesterday, a lot of folks said this is the top for the 10-year. I said be careful because it popped above 3.5. When a chart breaks above such important resistance, it produces a lot of energy to the upside. And yes, we're seeing the RSI, we're seeing the MACD being really overextended, but that doesn't mean that the chart has to go down right now. It can actually resolve all of these overbought conditions via consolidation, as we've seen with the US dollar. And that would be bullish for yields, bearish for bonds, and bearish for equities. We're not going to become bullish on equities, at least for a rebound rally, a relief rally, until we see a clear sign for a top and a reversal in both the dollar, the 10-year, here's the next one, the 2-year, which today managed to pop again, significantly higher. It looks that the 2-year is eyeing a certain number. Is it going to be 420? I don't know. Maybe that'll be too high. But if you heard Jerome Powell, in all likelihood, they're not going to be able to control inflation with that 5% in the Fed's funds rate. And the 2-year yield usually leads the Fed funds rate. But we're at least waiting for a pullback, for a relief rally. Do we have any sign that this is stopping and it's about to reverse right now? The answer is not yet. So for now, market bears are still in charge. And what about the TLT, a weekly chart? What's going on here? The TLT popped higher. It was a positive day. It is severely oversold. We know the story. Matter of fact, this is the biggest drawdown in the TLT's history. But is it enough to produce a bottom right now? The action that we got today is certainly encouraging, but we need confirmation. The confirmation would be closing above 109.5 by the end of the week. What about the VIX 4-hour chart? What's going on here? Now, the bulls will point at this chart and say, look, this is a sign that the market is about to head into a relief rally. Because why didn't the VIX pop higher today? It had more than ample reasoning and conditioning to pop higher, and it did not. That tells us that we have peak bearishness and we will see a reversal coming. This is what the bulls are saying. But for now, the bulls have a big problem. It is just a theory. It is just an opinion for now. It is not supported by the technicals because in the 4-hour chart, look at the MACD indicator. It is about to cross to the upside, producing more positive momentum. On top of that, we'll look at the daily chart for the VIX. It looks like a consolidation pattern, and we're about to see a breakout to the upside. And if that was not enough, look at the chart and the different cycles that it goes through. Stage number 1, the downtrend. Stage number 2, the consolidation. Stage number 3, the pop. The big pop. We have seen this repeatedly in the VIX. The problem is, this happens to be the most extended downtrend in the VIX so far this year, at least. Which means, is the pop we're about to get also the largest this year? If the answer is yes, then we will see a massive flush down in the SPY. And that solidifies the theory of the panic leg. Now we're about to see the panic stage in this bear market, and that usually comes hand in hand with a big crash. I'm just trying to present both arguments here. The bulls look at the VIX, the 4 hours, saying, look, it did not pop as it's supposed to be. And that is a good sign for the bulls. The bears would argue, not so fast. History suggests we have a massive pop in the VIX coming. And the weekly chart of the VIX supports the bears. Look at this. The week is still young. We have 2 days left. But if the VIX closes the week with a positive impression in the MACD, that usually means the pop is indeed coming. What about Apple, a daily chart? What's going on here? It couldn't make it above 157. This is a bad development for Apple. And by now, if you're watching this channel for a while, your eyes are trained to spot it. Here it is, an inverse ABC pattern. If it plays out, it could take Apple all the way down to 138.79. Tesla, an hourly chart, what's going on here? We talked about the closing below 310, the bear flag. Today, Tesla attempted to make it above 310. It failed. Not only that, it cracked below the trend line. Now we're eyeing 298 support. If that fails, we have 280. For now, I believe that the bulls are done with Tesla, at least from the hourly chart perspective. We'll see how the week closes, and then we're going to go over the weekly chart and the monthly chart of Tesla over the weekend. Lastly, Bitcoin, what's going on here? Yesterday, we talked about an inverse ABC pattern. Is the ABC pattern still on the table after today's action? The answer is yes. Maybe it looks a little different, but the bottom line here is Bitcoin got rejected from 20,000. This is not a good look at all. And folks, let's be honest here. This is a monthly chart of Bitcoin. We have a trend line that goes all the way back to 2017. Do you really think that we're not going to hit this trend line at some point? Think again. And if we do, that will be a downside for Bitcoin of over 60%. And Bitcoin will go down below 10,000. Now, this is the most extreme bearish outlook. This is not the consensus, but I have to present it to you because if we have the panic leg coming, we usually overdo it, be it in equities, be it in Bitcoin, be it in bonds, it doesn't matter. And if we overdo it, this scenario is plausible for Bitcoin. So keep that in mind. And here's the recap. What do we see right now? The daily charts remain in the bear's camp firmly. Yields are moving closer to the bear's camp after the pop that we got today from the 2-year. The Dixie is now firmly in the bear's camp after today's pop. Gold remains in the bear's camp. So is the VIX. Apple is moving back toward the bear's camp after today's action. So is Tesla. On the other hand, Bitcoin moved slightly away from the bearish camp because it did make an attempt at 20,000. But if we get a confirmation that it's not going to make it to 20,000, it's going to move away from 20,000 to the downside, it will move back firmly into the bearish camp. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims for the week, and then we have leading economic indicators. Folks, once again, a reminder, be on the lookout for my FOMC review. But with that, I'm done here. This is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
Calm down, Doctor. Now is not the time for fear. That comes later.